Thanks for joining us today for a discussion with Robert Teeter about the economy. I'm Rick Hough, Chairman and CEO of Silvercrest Asset Management. Rob is our Chief Strategist. Good morning, Rob. How are you today?
Good morning, Rick. Doing great despite the rain outside.
Yeah, it's pretty miserable out, but not so miserable. I want to pick up from a prior conversation when the Trump administration announced its aggressive tariffs.
Yes.
It was a punch in the face in many ways to the
Yes.
global economy because it was so strong and unexpected in terms of its broadness, height, and it was unknown at that time how long it would last, where negotiations would go. Your position at that time was that we were likely seeing peak tariff. Why don't you talk about that a bit?
Yes. So the day the tariffs were announced, they were quite substantive, well above where anyone expected them to be. Total shock to markets. We saw that in a big increase in volatility and markets declining. I think at the time when we had our discussion, you and I both talked about there were sort of two underlying objectives unfolding there. One was balancing trade, which can't really happen overnight. And the other was bringing parties to the table to negotiate, which we thought was a big, important piece of what
Right.
happened. And so our view was, look, these tariffs weren't even in place yet on the day they were announced. They were very high. They were designed to draw some attention. And our view was that they weren't going to go any higher and they were likely to go lower as negotiations unfolded. That negotiation process has been much quicker than I and others have probably expected, but it has unfolded. And we were at peak tariff then, and we're at a much better spot today.
And the importance of peak tariff was that the market was discounting the future based on that. They were going to be very prolonged and do real damage to the economy, perhaps leading us to something like a stagflationary situation, right? The economy was getting weaker. All sorts of trade was accelerated, which is going to affect GDP in the next quarter. Right. Obviously, it's like a tax. It's going to increase the cost of goods, right? So you've got a potential inflationary bump. So there were a lot of negatives that went along with it. That you briefly mentioned, there were kind of two paths at peak tariff at the time, and we didn't know what would happen, right? One, I think, was oriented towards permanently getting rid of the trade deficit, raising a lot of tax revenue as a result to either allow for further the continuation, I should say, of the tax cuts, right, or otherwise lower the deficit. And the other was more of a rebalancing of the global economy, that there were excesses in other countries and our own national interests at stake that needed to be dealt with. Yes. Looks like we know what path they're taking now.
Yes, lots of negotiation, moving in a direction of using tariffs to bring parties to the table. We're in a situation where the higher tariffs are on pause for at least 90 days, stated 90 days. It could extend, and that's been alluded to. And it's a situation where there's a recognition that the worst of what was announced, in terms of worst meaning drag on the economy and increase in inflation, is not happening. And that we're in a spot where there is negotiation and the backdrop has been improving. And so I think one of the things we've really focused on throughout this issue with tariffs, and will continue to do so, is that we're focusing on it in an incremental way. Whatever's announced isn't necessarily going to be in place indefinitely. And that remains true of what's been recently announced as well.
Where are we with China? Just because that's the big.
With China, we're around
player.
30 on the announced. It could be a little higher depending on certain areas that have higher tariffs. There is a possibility of peeling back to 10% because of the 30, 20 is based on the fentanyl situation, the fentanyl-related tariff.
So they just put a number on it. Is that what you're saying? Okay.
And the reason that's important is there's a path to eliminate that 20. So if there is progress made on the fentanyl issue, the 20 could presumably be removed, and then we'd be at 10% universal.
Yeah. What is China at? Where are we? All parties at 30? Where are the different parties?
So rest of the world is essentially 10.
Right.
There are some areas that are 0 under U.S., Mexico, China, but basically 10 with China at 30. And so most people calculate a weighted average tariff on all imports into the U.S. somewhere around 12%, perhaps a little higher.
Okay. Where I'm getting at is prior to this negotiation, where were U.S. tariffs, and importantly, where were China tariffs?
Yeah, so they were lower, weighted average around the world, for the US was around 2.5%. So we've increased about 10% or so.
Okay.
So that's part of the math that we put into place in our model of estimating drag on GDP and
Because it
increase
will
in
have a
inflation.
negative effect, of
It
course.
absolutely will. So
Right.
as much as the news is better than announced on
Right.
April 2nd, there is still a drag on GDP,
Sure.
an increase in inflation. And we estimate that to be somewhere in a range of about 0.4% to 8.
So there is some damage, and
Yes.
we saw some in the last GDP numbers because trade was accelerated,
Yes.
which just as a mathematical certainty, you're going to take some GDP growth from the next quarter when
Yes.
you do that. That's short-term thinking.
Right.
But we're seeing other data, consumer, household,
Yep.
it's, employment. What are we seeing there in the economy, and what does it portend for the future?
So some pretty decent strength. A few numbers that I look at. So two in particular are the hires rate, which is the percentage expansion or detraction
Right.
in payrolls, and that's running at about 3.4%.
Mhm.
And the expansion in wages year over year, which is running at 3.8%. So as a back of envelope, I put those two together, back out inflation, and get at something that I think of as potential to spend. And that's running north of 4% right now. Now, savings rates have gone up a bit, so spending hasn't been running quite at 4%.
Which is a reflection of people being fearful
of
in the
uncertainty.
environment. So as the
Yes.
uncertainty is straightened out, that is potential cash to go to work.
Exactly. And first quarter, despite the negative reading on GDP, the important pieces such as personal consumption or spending, the
Right.
consumer part of the economy, growing around 2%. So pretty decent strength there. We've seen some real-time data all the way through April, even into the beginning of May, that indicates that pace has continued. So there hasn't been a dramatic drop-off even from April 2nd through the end of April, at least what we're tentatively seeing from retailers and from credit card data and things like that.
Right. So that's the real economy. We like to
Yes.
focus on that.
Yes.
And I've heard you say that there's way too much attention paid to the Fed. Let's focus on the real economy, what's
Yes.
happening. But we can't avoid the Fed. We
Correct.
can't avoid interest rates. They spiked. They've come back in. What does this mean for the Fed and interest rates over the rest of the year?
Yeah, so with the Fed, there are sort of two messages people are focused on, and I think they're overly focused on what I would consider to be the wrong one. So I'll start there, which is the tariffs will be inflationary, no doubt. Inflation is above 2%, no matter which way you measure it.
Right.
So there's been this knee-jerk reaction to say, well, tariffs are going to push the Fed further out, and they're not going to be cutting. And the problem with interpreting the message that way is, in my view, the Fed is remaining on pause right now in a very what I would call hard pause way, for good reasons. Meaning the economy is doing fine. They don't need to cut rates with all of the economic data that we have seen to date. And so long as that continues, they're unlikely to cut. That's a good thing because they have a lot of tools at their disposal should the economy start to weaken. So while it is true that higher inflation for longer is keeping the Fed on pause, they're able to do it for very good reasons as well.
And
meaning
probably
a
better
continued
they
strength
have
in
tools in the
economy.
toolbox as
Yes.
well if they're needed.
Absolutely.
Right.
Absolutely.
I think the biggest component of future potential growth of the economy, the biggest indicator is actually the stock market.
Yep.
And that has, after peak tariff, actually been performing pretty well. Where are we this year?
Yeah, so the S&P 500 is around flat on the year. It's up just a little bit as of the close yesterday. And that's a good signal. That combined with removing some economic policy uncertainty, getting some clarity on where we're likely to end up on tariffs, I think starts to put companies back in a mode of being able to plan for the future, whether that's for CapEx or IPOs or M&A. And that's a very favorable backdrop. So we think that will continue to gradually improve in the months ahead.
Right. And we noted in our last conversation about peak tariff or tariffs in general, when we didn't really know the direction, that the market at that time, after some pretty volatile sell-offs, scary,
Yes.
nonetheless was about flat year over year
Yes.
at that time. Now I think it's up something around 12%
Yes.
year over year. Amidst all this noise, it's kind of hard to forget that.
Absolutely. It's very good to step back and look at those longer term time frames, both in the rearview mirror and in thinking ahead. Just back to the point on tariffs from the beginning of not necessarily assuming that what was announced
Right.
would be in place for the next 365 days. So have to look out a little bit further. And like you say, it's important to look back and
You
see where we've been.
you also had very constructive comments about asset allocations being in place for a reason,
Yes.
right? It is to work through periods of uncertainty and to establish a sound basis for the goals someone may have in their portfolio.
Yes.
But it only works as long as you can stick with it with a
Yes.
sustained period of time.
Yes.
You warned that the snap back could be just as swift as the downfall, and it would
Yes.
be nearly impossible at the time. Because as soon as there was any certainty about the path, the market would react.
Yes.
And in fact, I can't imagine that anyone was able to time that properly if they sold out
Yes.
out of fear
No,
on the market.
I agree. These timelines are incredibly important, and when it's something that has the potential to go down or up very quickly and reverse itself, it's really important to have a plan in place to see through that and not try to trade it day to day.
There's
we've
no way
seen
it could have happened.
many peer and professional organizations, many talented people changing views nearly every day with the news flow that's occurred over just the last 4 or 5 or 6 weeks. And that's
Right.
not a period of time in which people can time the market.
At the end of the day, we care about fundamentals.
Yes.
Our portfolios here are bottom up for the most part.
Mhm.
Almost all of our teams care mostly about the performance and potential for each individual company, nature of their balance sheet, right, their growth horizon,
Right.
their earnings, et cetera. That is fundamentally what is going to support the market and companies in the market. What are you seeing there? In particular, let's start with the Mag 7, since they've been such a big story over the past year and a half.
Yeah.
What have they looked like this year? They obviously have led the way in terms of the S&P being flat for the year.
Yeah, it's been a very strong rebound. So this quarter, they're up quite significantly. And I think in some ways with good reason. There's a tendency to take a name like the Mag 7
Right.
and think that that means a lot of negative things, that only some companies are leading the way. And for the most part, maybe not specifically those 7 companies, but large cap tech companies are doing a great job of generating earnings. And so they have earned their way into the position that they're in. That does not mean that they're the only place to find opportunity in the market. There are many other fantastic companies out there. But I do think it's important that people don't dismiss large cap tech by just saying, well, it's just a Mag 7 phenomenon, as if we can or should ignore that. There are some very good large companies, just like there are some fantastic small companies.
Right. The reason we're talking about the economy and the effect of what we've seen is because ultimately it is reflected in earnings growth, which supports S&P valuations. So where do you see that over, let's just call it the next 24 to 36 months? We don't like to talk about just this year.
Right.
You can if you want, but
so the way I look at the next 3 years is to say that I think at least on a short-term basis, we're perhaps a little bit what I would call stretched on a valuation standpoint. So we're a little bit higher than we should be versus history, given where interest rates are, given where earnings are. That's not necessarily a problem.
And it's a reflection of the environment.
It's a reflection of the environment, which can change and likely will change. So my view looking out 3 years is interest rates will decline from where they are now. That will provide some further support to valuation. And the economic backdrop looks sound, around 2% or more of growth, which traditionally is high single-digit earnings gains. So I think we have a very constructive backdrop for equities over the next few years as valuations kind of grow into their own as interest rates and inflation subside somewhat. And as companies continue to put up good earnings growth on the basis of the economic backdrop, as well as some of the transformation we've seen in the economy with potential to increase profit margins. So pretty optimistic over the next few years.
Great. Thank you very much, Rod.
Thanks, Rick.
Appreciate you
Great to
talking
see
this
you
morning.
again.
Good to see you.